Welcome to my video. I'll trust you'll find it helpful and informative. Please remember to like and subscribe. Thank you.
Hi guys, so we are still busy with the year-end accounting for sole proprietorship as it pertains to financial statements. And in the previous video, we had a look at this question and then we did the journalized adjustments. Now, you'll remember at the end of this question, it said that we were supposed to do three things. The first one was to journalize the adjustments. And we have already done that. And then we are supposed to prepare the income statement for the year ended, whatever the year end is, as well as draft the statement of financial position for the end of the year. And then it also tell us we must prepare the notes to the financial statements. Now in this video, I'm going to look at this 1.2, prepare the income statement for the year ended 31 March 2023. And then I'm also going to look at the two notes that relates to the preparing of the income statement, notes 1 and 2. Now, before we even start, just understand what the income statement is. The income statement tells us exactly what our income was, what our expenses was, what deductions in terms of interest there was afterwards, so that we can in the end see what our net profit is, because that net profit amount is what we need to bring into the balance sheet. So we have to do the income statement before we can do the balance sheet. Okay. Also, you will see here, I've given you a little table that says new balance sheet section and new nominal account or income statement section. And if you look at the pre-adjusted trial balance, you will see in the nominal account section, which is this part, that there are many entries, but there are certain things that does not appear in the pre-adjusted trial balance and that must be added. And they are added based on the fact that we did journalized adjustments for them. In the previous video, we did that. So let's have a look at it. So now we will see that there is a provision for credit losses adjustment that must be added to the income statement. There is a provision for settlement discounts granted that must be included in the income statement. And remember, based on whether the original allowance was more or less, this can be debited or credited. Then there is depreciation that happened and that we do not find in our income statement, but that was the topic of our first two adjustments. And then there's the interest on the mortgage loan, which we have to add to interest in note 2, because that also didn't appear here in our pre-adjusted trial balance here in the nominal account section. Okay, so remember, whatever you see nominal account section here, that will reflect in your income statement that you are supposed to do. Now in this case, I already completed the income statement. And I've given you notes on the side so that you can see how we arrived at the amounts that I have in the income statement. So let's have a look here indeed at the income statement. Okay, so this is the statement of profit and loss and other comprehensive income, and it says other, you see everything else, of ABC for the year ended March. Now the first thing we start with our sales. Then we are going to subtract our cost of sales, because that's going to give us our gross profit. Then we are going to add all our other income so that we can get to our gross operating income. Then we are going to subtract all our operating expenses so that we can get to our operating profit. Then we are going to add the interest income deriving from the note 1. So that we can get our profit before interest expense. Then we are going to subtract our interest expense derived from note 2 to get our net profit for the year, because it is this amount that says net profit for the year that we need to put into our balance sheet. Okay. Now, what is a note? will be a good thing. A note is simply a little calculation to show how we got to the amounts that is reflected in our financial statements. Now, when we did our journalized adjustments, we also made calculations too, but those, of course, the journals are internal documents, so we don't have to prepare those as notes. Nobody else outside the company is going to see that. But when it comes to our financial statement, our income statement, and our balance sheet, remember, those are for external stakeholders. They will want to see it, and we can't just put an amount there. We must indicate to them how did we get to that amount, and that is why I have notes 1 and 2 here on the income statement. Okay. So let's start with sales. Sales, it says 608,883 minus 26,829. Now, where did I get that? Well, if you go and look here at our pre-adjusted trial balance, you will see that that's the amount that we have for sales minus the sales returns, because the sales returns must be subtracted, because it's really as if that never happened. So when we look at our income statement, we simply say that that is the total we get, and we simply read that from the pre-adjusted trial balance. Now we must subtract our cost of sales, but our cost of sales is a little more than it reflected as in the pre-adjusted trial balance, to the tune of 996. Where did that come from? Well, firstly, we read from the pre-adjusted trial balance, 294,363.20, and then we must bring in journal entry 426. Let's go and have a look again at what journal entry 426 was. It's this drawing taken by the owner, remember? And this drawing that was taken by the owner will affect our cost of sales, of course, so we have to count for that in the income statement. So we bring in journal entry 426. Our cost of sales has actually increased with 996.49 when he makes a drawing. Okay, now that's simple. Now that we have the sales and the cost of sales, we can simply say, well, let's add them together. Or really what you would do, you would subtract your cost of sales from your sales. But for me to make it easier in Excel, I just indicated cost of sales here as a negative number so that I can drag down and add. Okay, you would not have a negative sign there, but what you would do is you would subtract the 295,369 from the 282 amount. Okay, and then we get to our gross profit. Now that is wonderful. Now we have to calculate our other income. Now what you will see here is, here in our column here, we have an amount, and this amount is derived from the amounts under it. So it is, like I said there, it is the sum of the 5 or however many rows below. Okay, so let's firstly have a look at. Firstly, we have the rental income. Okay, so with regard to the rental income, we have an amount, the 37125 again, that we read from the pre-adjusted trial balance, but now we have to bring in journal entry 421. I'm going to show you what journal entry 421 was again. Journal entry 421 was this accrued income, the rental income. Okay, so it's rental income that we were supposed to receive, but we haven't received it yet, and so it had to be added to our rental income, and that is why we say plus 3375. That gives us a total of 4,500. Then we have the credit losses recovered. Now that amount of 2,805, once again, that was in our pre-adjusted trial balance. And the 2.1 was from journal entry 418, if you can remember. That is where we received that payment. We saw that payment in our bank account, and it was from amount that we had previously written off as irrecoverable, and so we have to add that to our credit losses recovered. Okay. With regard to the dividend income, we simply read that from the pre-adjusted trial balance. There is nothing else. Okay, then we have to look at our packaging income. Now, with the packaging income, I said the 54,714 read from the pre-adjusted trial balance minus the 4,208. Why minus 4,208? Because as you can remember, this packaging income was paid to us in advance. And so when we have a look at our income statements, we have to subtract that amount, and that reflected in journal entry 422. What you should realize at this point in time is that if you messed up your journalized adjustments, there is no way you are going to complete your income statement or your balance sheet with any success. Okay. So please make sure that you do the journalized adjustments correctly, and then you can just pull through that information to your income statement. So the allowances for credit losses adjustment. Now you will remember, as far as the credit losses adjustment was, we saw that our allowance was more than what was required. So when we make the adjustment, we can take that adjustment as an income. And so we brought that in through journal entry 416. Okay, you can go and have a look at that in the previous video. Okay, now we add up these 5 amounts here, we get to 103 Rand. Now, obviously, that other income will be added to our gross profit, and then we get our gross operating income. Okay, now we have to look at our operating expenses. Now, once again, this amount here appears first, but it comes in last because it is the sum of this case 13 rows below. Okay, but it can be as many as you need. It's just the sum of all the operating expenses. Okay, so let's have a look at it. Rates and services, there was an amount there of 11,814 that we simply read from the pre-adjusted trial balance. But then you will remember we received that other invoice for rates and services, so I remember correctly. Just have a look. It's 419. 419 rates and services. It was an accrued expense. Okay, so it was an expense. We were supposed to pay for it, but we didn't pay for it, so it didn't reflect in the pre-adjusted trial balance. And then when we make the adjustment at the end of the financial year, we have to account for that. And of course, that is what we have done. Then we have the credit losses. Now, the 4026, once again, that was read from the pre-adjusted trial balance, but the 367, you will remember we received that check from the guy. I think we recovered 60% of what he owed us, but the other 40% we had to write off as irrecoverable, and that was journal entry 415. We can quickly go and have a look at what happened in journal entry 415. It was Mr. Kellerman. Okay, remember, we could only recover 45% it was, and the rest we had to write off as irrecoverable. Okay, so therefore it will increase the credit losses. Then we have the allowance for settlement discount granted adjustment, and in this case, that allowance is an expense because when we did the calculation, we saw, we underprovided here. Our allowance is not enough, so it has to be increased by a further 102.60. And we simply bring in journal entry 417 there. Okay, there was nothing. We don't have to have a look at what was in the pre-adjusted trial balance because we only have to look at the difference, whether that is an expense or an income. Then we have a look at the delivery expense. Now, the delivery expense was 11,682, read from the pre-adjusted trial balance. But as far as the 458 was concerned, that was part of journal entry 424. Let's have a look at what 424 was. Remember, 424 said trading inventory. Oh, this was the mistake. This was where somebody thought that there was the delivery expense, and then we had to write back the transaction and write it to the correct transaction, which was trading inventory, and that is now reflecting here in our income statement because that amount was incorrectly charged to delivery expense, so it must be subtracted. Okay. Then what about shop consumables? Okay, as far as shop consumables was concerned, we read the amount of 4125 again from the pre-adjusted trial balance, but then it decreased with 2,145 according to journal entry 426. Now let's just have a look at what journal entry 426 was. You will remember that was when we actually went and we did the stock take, and that was the amount for shop consumables. Just a note here, when I did this in the previous video, somehow when I whited this out so that it could appear when I'm doing the video, I deleted it and so it didn't appear. So if you want to go back, just make sure that this amount, consumables on hand of 3125 that we got, was the sum of the shop consumables and the postage and stationery. Okay, so with the income statement, of course, we have to subtract that amount because we still have it on hand. So we can't say that our entire expense for the 4125, all the shop consumables were used, but of course we still have shop consumables to the tune of 2,145 on hand. The same for the postage and stationery. Okay, the pre-adjusted trial balance says that the amount is 1782. But when we do the stock take, we find that there is still postage and stationery items to the tune of 980 Rand and 10 cents there, and obviously the same journal entry because the two gave us the total. Okay, then we can go and look for insurance. Now you will remember, once again, we read the 7029 from the pre-adjusted trial balance, but as far as the 540 was concerned, remember that was something that we prepaid. So it is an expense that should not have reflected yet. So we can subtract that 540 amount. Okay, that was journal entry 420. Then we have repairs and maintenance. The 4455 was read from the pre-adjusted trial balance. And then you will remember at the very end, last day of the month, we received this invoice for repairs and maintenance, and we had to bring that into the journal entry. It was journal entry 4223, and that is why we now add them to get to that amount. The other things, the telephone and fax, the staff refreshments, the rent expense, the wages and salaries, all of those is simply read from the pre-adjusted trial balance. Okay, now we get to the depreciation. Okay, now this depreciation that we have here was brought in through journal entries 412 and 413. Remember, we go there, I said to you, if we have a look here, depreciation didn't appear on our pre-adjusted trial balance, so we must bring it in because we went and create journalized adjustments for it. So now we say, okay, though that depreciation is the sum of the depreciation on, I think it was plant and equipment we called it, and vehicles. We can just go and have a look. The one was for plant and machinery, it's called it machinery, not equipment, and the other one was for motor vehicles. Okay, and of course, in our income statement, we treat depreciation as an expense. Okay, and therefore we add the two together and we get to 44519. Now we go and we add all of these operating expenses together and we get to a total of 23542. So if I have my gross profit, okay, or my operating income, which was the gross profit plus the other income, and I now subtract my operating expenses from it, I am going to get my operating profit. Okay, that's operations. But now we have this thing that is either regarded as an income or, sorry guys, about that, either regarded as an income or an expense based on interest income and interest expense, but it's not relating to operating. So that is why we have to add it later, and we put that down as a note. Now, what do we say in the note? We say, okay, let's look at note 1. Note 1, we have interest income. And we say that the interest on debtors account is 5445. And where did we find that? We simply read it from the pre-adjusted trial balance, so we can bring in that amount of 5445. We add it as interest income. Okay. And then we get our profit before interest expense. Now we have to calculate the interest expense. And here you will remember there will be amount that we read from the pre-adjusted trial balance, but we have that expense on the loan, the mortgage loan that accrued interest, and it didn't appear anywhere. And so that's an expense that we should not have ever have had. We should have just paid it, but wasn't done. And so now we put the interest on the mortgage loan. That was journal entry 427. If you will remember, I think it was almost the last one that we did. Could have been, yes, it is the interest on the bank loan that we calculated there. And you've got your reasoning there. I'm not going to look at the journalized adjustments again. And so we will add that to the amount that reads as interest on creditor's account on the pre-adjusted trial balance. We will add that, it gets to 19,671, and then we get our net profit for the year.